Good afternoon and welcome to the ZOTEFOAMS PLC interim results investor presentation. For this recorded presentation, investors will be in listen-only mode. Questions are encouraged. It can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to David Sterling, CEO. Good afternoon.
Good afternoon, everyone. Welcome to our interim presentation. I'm joined by Gary, our CFO, and we'll just dive straight in then. So we think about the business in three separate business units: polyolefin foams and high performance products, or HPP, both of which are manufactured using a unique autoclave technology from facilities in the UK, in Kentucky, North America, and Poland. All of our HPP products, the foams are manufactured in the UK, and the UK facility also makes the polyolefin foams, as do Kentucky and Poland. Extrusion technology is a very small part of our business in terms of revenues, bit more so in terms of costs. We're investing quite significantly to develop some application spin-offs from that technology, and we'll cover that later. The business strategy is one of applying those unique technologies into chosen markets where we think we have the opportunity to be a market leader. And that's based around creating differential advantage that benefits us and our customers. Our strategy is one of organic growth. We have in the past done some very small bolt-on acquisitions, but really it's about organic growth in these interesting markets, and there's plenty of interesting markets out there. In the period, 6 months to June this year, we increased revenue by 9%. Our high performance foams were up 11%, and our polyolefin foams up 10%. What's not there is MuCell. It's a very small number, and we'll cover that later on. With those better sales and better pricing, we've improved the gross margin up nearly 400 basis points to 32.8%, and a very large increase, 30% increase in profit before tax. As I said earlier, we are investing significantly in our MuCell stroke resource application, and if we exclude those costs, our profit before tax increased by 49% to 9.4 million. Earnings per share up 22%. We have strong cash generation. We've paid back in the last 12 months 10 million of debt, and our interim dividend increased by 4.5% or just over, basically showing the confidence that we have in the business currently, and our very strong cash generation and relatively low debt levels with a multiple of 1.1. Strategic highlights. One is how we've actually delivered that top line, bottom line, that margin recovery, basically through realignment of our selling prices with the costs. Over the last couple of years, the cost base has really jumped all over the place with rising energy costs, polymer costs going up very rapidly from lows experienced during COVID, and really well overshooting the long-term average, now realigned with that long-term average. And of course, labour costs, we're seeing that coming through the system now, as well as a whole load of other industrial inflation in freight and associated costs, along with supply chain disruption. So to have a period where those input costs have basically moderated, the selling prices have kind of caught up and are now appropriately balanced with them, particularly in our polyolefin business, we'll see that margin recovery very strongly. In our high performance business, we're feeling very good about the aviation market. Again, not shown through there in the first half numbers, but that's just a timing related issue. And with Nike, who are about a third of our business now, we have an exclusivity agreement. We supply foams for high-end running shoes because the materials that we make have really good energy return, better than anything else on the market. And that exclusivity agreement we have extended for another 6 years to the end of 2029, showing very strong alignment between us and Nike. And then finally, strategically, we have been developing the resource barrier material for consumer packaging. We've really focused that around cartons, where we believe we've got a significantly different product than is out in the market with a better carbon footprint. And to commercialize that, we've signed a joint development agreement with a world-leading packager of beverages. And that's looking basically to jointly develop into a commercial trial in the first quarter next year with a European retailer. I've got an example of that package type that you will see hopefully on the shelves in a few months' time. And at the appropriate point, I'll switch the camera on and you can have a quick look. Just to let you know, the profit we have delivered, I said, excluding the resource-specific costs, we've shown those there, so you can see exactly how much we're spending. It's a decent amount of money. We believe this is a high opportunity project. It is higher risk for ZOTEFOAMS for a number of reasons, but as we look at this, the technology really does something very different in the market, and there's a lot of interest in it, so well worth investing in, we believe. The shape of the business is very similar to we have seen in the past, geographically diversified, industrially or by markets, again diversified. That's a 6-month-old slide on the bottom left, but not changed significantly in the first half this year. And really we've delivered that growth through, if you think about pricing within the polyolefin foam business, volumes in our HPP business, and both with an FX foreign exchange tailwind from the US dollar predominantly. I'll hand over to Gary to talk us through the financial review, and I'll come back to talk in a bit more detail about the business unit segments.
Thanks, David. Start with the income statement abbreviated, and just a reminder, we do share adjusted numbers here, which is often for our analyst community. The impact is very minimal versus our reported numbers. It's about £130,000 this year, not a lot different, 120,000 last year. So pretty minimal impact, larger impact for other businesses, I guess. But and this really, the adjustment is really to take out the impacts of amortization on acquired intangibles. And for us, the acquired intangibles are assets that form part of the MuCell acquisition many years ago. And so we're starting to get down to zero there. Just the background there. As David said, revenue up 5.6 million or 9%, up to 64.5 million. 3.3 million of that is currency benefit. That flows through to gross profit of up 4.1 million at 21.2. Obviously partly led by the group revenue increase, but also by that 390 bips increase that David referred to. Really driving elements of the gross profit increase are the full year impact of the polyolefin foam price adjustments of 2022. We made 3 during that first half period, and the final one wasn't until May, so the full year impact there takes effect and is visible in our numbers this year. We've seen raw material costs come down. They're similar over the whole year. They've been coming down since they reached a peak during last year, and they've been running around the long-term average for most of this first half. We have seen them drop off further in July and August, and I've got a chart that I'll take you through on that later. Energy costs have stabilized at a higher level. They're up 20% versus this time last year, but they are we've pretty much bought ahead for the whole of this year now, so we're pretty confident that is where we will be. We have good visibility over that. Offsetting some of that sale and BIPS impact are some costs in addition to the energy. Labour inflation, as you will imagine, is up across all of our regions. And we've also been increasing our operating investments and our costs in key manufacturing capability, both in Poland as we increase capacity and run that plant more. And that's certainly been the case this year. And also in the USA, where we've made reference in the past few reporting periods to inefficiencies and operating opportunities, which we've been grasping both by hiring more people, better qualified people, and tackling some of the challenges that we've been faced, which have arisen really from the COVID time and our inability to work closely with the guys out there. If you look at costs, distribution admin cost, not a lot of movement, not very much driven by business activity and labour costs, whereas the administrative costs are up 2 million, as you can see, up 29%. 400 of that is the hedging, where the actual hedging activity pros and or benefits. 100,000 negative for this first 6-month period, but also we've been investing higher in our technical costs across the group, primarily the quality department, and increased our investment in resource. That takes us to an adjusted operating profit of 8.6, up 29% in the period, and a margin up 2%. Interest charge, if you look at the P&L, doesn't look like much, 1.1 to 0.9, but it's actually greater than that. It's actually up £500,000, and that's in part due to the fact that last year in the first half we took a £300,000 charge as a result of costs that we had capitalized relating to our financing facility, that as we renewed the facility last year, we hadn't fully amortized and had to take in one go. So the £500,000 is of course related to interest rates almost entirely. We draw down debt both in dollars and in euros. That's the consequence. We do have a little bit of benefit coming through the fact that our leverage has reduced. We're a ratchet system in terms of the margin, so we've got some favourable element there. But of course, the general tide and increase in interest rates across the world have impacted us too. That leads us to adjusted profit before tax up 29%, 7.5 million. Tax charge really is solely related to the change in corporation tax rate. We're now at 25%. Something's just gone. Oh, no, I can hear myself. I can hear myself twice there. So that's purely the corporation tax rate, leaving us with adjusted profit after tax up 22%. David mentioned EPS, mentioned interim dividend, the interim dividend as well, up 4.6% at 2.28 pence. If I move on to the abbreviated balance sheet, the key observations there, first and foremost, the intangible assets moving upwards entirely due to our resource capitalization of development costs. PP&E is down. For the first half, our additions are around 1.6 million. That falls well short of what is expected for the year and is shared by the analysts, which is around 10. So the spending will be significantly higher in the second half of the year. But as at this point in the year, we're down, we're lower, additions are lower, the depreciation plus a bit of FX means that, as you can see, PP&E is down 4%. That will change in the second half. Other assets are up, driven entirely by our hedges and the reval of those hedges as at June 30. Net working capital, I'll go into the detail of that on the cash flow slide that comes next, but as you can see, primarily here, there's little movement in total on the balance sheet from this period to the previous period. That leaves us with a net debt of 28.3, down 10 million on last year. Pretty similar, up 500,000 on the year-end position. And leverage as a result is at 1.1, down a notch from the 1.2 at the year end, and down quite considerably against the 2.0 that we reported this time last year. Just a reminder on our debt facility, which we hold with Handelsbanken and NatWest, 50 million multi-currency RCF, with a leverage of 3.5, so that's significantly above where we are at the moment, where we really ever have been through the last 5-7 years of COVID and the capacity increases. We do retain an accordion of 25 million should an opportunity arise. This particular facility is linked to ESG. Very small financial impacts of that, a few bips up and down based on the achievement of targets. We met all of our targets in our first year last year, which gives us a few bips benefit, and that will continue obviously on for the next few years too, until the end of the facility, which is March 2027. On the cash flow, just change that. On the cash flow, again, good profit performance drives as a starting point for the cash flow movement and the good cash generation. I mentioned the actual working capital position is pretty similar to last year, and indeed the movement in working capital is similar from January to June this year as it was last year, around 6.5 million versus 5.8 last year. But as you can see, the makeup is quite different, and the primary driver in this first 6-month period is inventory, and that really relates to two particular factors. Firstly, this time last year, we experienced quite a lot of scarcity in critical and key high-value raw materials for our azote business, which resulted in us not being able to deliver. We've taken that on board. We've ensured that we build safety stocks for these high-margin azote opportunities, and that's really driven a good £1 million worth of inventory build this year. On top of that, for the last 4 years, pretty much since the start of COVID, we pretty much have not bought any PVDF, any of the key raw material that goes into the aviation space. We had sufficient. The market fell significantly, and we've been drawing on that inventory through COVID and up until now. This year is the first year we're purchasing PVDF materials again. That particular purchase came in just before the half year, and as a result, timing related, we have a significant boost in that inventory. So good news, because it means that we've got the market's recovering. David will talk about that, and we're replenishing stocks to meet that. That gives us cash generated from operations of 5.8 million, up slightly on last year. Interest and income tax, I think that's evident. Higher interest rates, higher interest charges, higher income tax being paid. The last couple of years, we have had some rebates that have reduced the overall tax paid. We're pretty clean now. There's none of that in this first 6-month period. Moving on then, as I said, you can see the capital there. You can see the 1.6 I referred to on the PPE, which will increase in the second half, and you can see the increase in the intangibles, most of which is the resource investment. If I move on then to my final slide, which is a slide I've been presenting the last few periods, and that is where I look at maybe the 3 key areas of cost and influence around the business. Slightly amended the look of the chart for those that recorded over the last few periods, but still sending the same message. This is our LDPE polyolefin foam primary raw material and the evolution of that over the past few years. The blue is the core ethylene price, and the red is the spread, giving you the total price that we've been paying for LDPE over the past years. You can see the spike and the increase up to 2,250 euros a ton, which we reached around mid-year last year, which compares to the historical average of around 1,300, 1,400 euros. You can see that came down rapidly towards the beginning of this year and stayed fairly stable up until about now. And so we've kind of had an average, the average price has been through this year has been fairly similar to what we would historically experience. But you can see that as at today, and indeed through July, August, the spread is very low, and we're benefiting from that, but we expect that to recover. That is not a sustainable margin we would expect from the producers, so we expect that to return probably in Q4. The energy costs through our 3 main sites are, of course, our autoclave technology plants, But 3/4 of our entire energy is consumed on site here in Croydon. As I said, those prices have stabilized. They're about 20% higher this 6-month period versus purchased ahead. We weren't doing that last year. It was very difficult to be doing that last year. But this year we've got more visibility and it's more, the prices are relativized, and consequently, we expect those prices to remain at around the 20% above last year position. Then the final of the 3 primary influencers is the foreign exchange. Most of you will know we very much invoice outside of sterling. 90% of our invoices are either in dollar or in euro. The euro is historically and remains naturally hedged. We invoice all of our AZO business into Europe in euros, and we purchase all of that LDPE in euros. We purchase quite a bit of our HPP in euros too, so the consequence is a natural hedge. That's different with HPP, where almost all of the products are invoiced in dollars, and where only a small share, and it's a part of our footwear business, only a small part of that is purchased in dollars. So we're very long on the dollar and take the benefits and the hits subject to where the exchange rate is moving. We had a 5% average decrease in the exchange rate this half versus last half. That generated 3.3 million of revenue benefit, 1.1 million of PBT impact after the 400,000 of hedging costs that I referred to earlier. And with that, I will pass back to David.
Thanks, Gary. So business review. As I said, we think about business in three main business units. The first of those, which is 58% of group sales, is our AZO polyolefin. Gary's talked quite a lot about the cost side of it, so focus on the revenue side, up 10%, where we have basically achieved that by selling prices and product mix with a little bit of help from currency, offset by a fall in volumes. The fall in volumes really related to continental Europe and the rest of the world, whereas North America and the UK were relatively flat. And if you've been following the news, I think the relatively soft European industrial economy in the second quarter, it will be no surprise to you. We have got a bit of product mix changes in there. As our prices have gone up over the period, customers have come back to us and said, what can we do? And often that is, well, buy a lighter density foam. It costs less. We use less raw materials. It's got a lower carbon footprint, or we've got foams with recycled content, etc., where these take a little while to substitute the more premium materials because people need to adjust their equipment, or they need to specify them or test them or whatever. But that's sort of happening now as people look for the better value, lower carbon footprint materials. So that right product as well as right price is very much part of our agenda just now. And as we see industrial deflation, that applies to us. We had put our prices up, not this year, but throughout last year, and we're seeing the full period benefit of that this year in polyolefin, along with the different cost base. We have actually now started removing some of the surcharges we put on in pricing. Now, sometimes that's been replaced by a fixed price. Sometimes it's just being removed depending on the margins, the application, the marketplace, etc. So what we've seen is the segment profit margin, grow very significantly up to 13.2%, which is a fairly decent performance, and it's in line where it's been in the past there. If we go into our high performance products, which are 41% of group sales, Different story here. Revenue up 11%, primarily driven by sales volume, and again, a bit of currency tailwind. Not really pricing increases in these segments in the period. We are seeing some increases in raw material prices and the more technical materials coming through the back end of this year, and our pricing is being adjusted through, for example, the aviation sector, but more likely to impact 2024 than this year. Overall, that 11% growth, footwear up 14%, and footwear now is 35% of group sales. With Nike, we have a clear contract where prices are adjusted every 6 months in relation to our input costs and FX. So that's something where the margin moves around a little bit, just depending on timing, but in the period was fairly similar to the last period. Aviation down a little bit, 9% in sales. Not concerned about that at all. That's really to do with timing and offtake. What we're seeing in the segment is that we're having higher aviation build rates, particularly with us. We are more exposed to Boeing. They've got high order books. Those build rates are still not where they were pre-pandemic, mainly because of supply chain constraints, not from us, but from other people. And therefore, you know, we are seeing that increasing in a very full forward pipeline on that. It's looking good. T-FIT insulation sales up 9%. Two major markets there are China and India. China is, you know, has been a bit start-stop because of the economy there. So it's but I was saying to someone earlier, I've never turned up for a long time and said the economy is smooth right across the world. It's just not. So we take the bumps in the road as they come. I think overall segment margin, you know, pretty much in line with where we were last year, and the profit growing in line with the revenue. And then finally, to talk about the MuCell business unit, really it's a story of refocusing. We've taken most of the people there and focused them on our resource technology, the existing MuCell licensees, and some new customers in very specific markets where we know the technology works are being serviced, but majority of the team are now focusing on the resource project. So it's really, think of it as a development business where the costs are the important thing, and the timing of bringing that technology to market is important. So what have we been doing? We've been working on the formulations. We've been working on the scale up. We've been working on the downstream processing of our technology and aligning up commercial partners. So we have a facility in Denmark, which we brought into the group less than a year ago, and that will be used to manufacture the resource sheet, the base sheet of the material. And then we will print and create the carton preform and sell that to a packaging company. The packaging company turns it into carton, fills it with the juice, and sells it to the retailer. So we have got a European retailer on board for Q1 trials next year in market. We've got a global leader in the packaging market signed up as a joint development partner who will supply into that market and also help us with the challenges of putting our products through existing packaging machinery. And that's particularly important because our technology has been designed to use existing packaging machinery where possible to allow the infrastructure to support the resource introduction longer term. So it is primarily a high risk, high reward opportunity, but the market global market for beverage cartons is enormous. It's about 300 billion cartons a year. We wouldn't be suitable for every such product, but a very, very significant part of the market is in scope for us. And we have, in fact, other technologies that we could use in various other parts of the packaging market, but we've decided at this point really to focus on the carton market. So that's the story of the business units. If we just look, I've got 2 more slides, and I'll talk about the outlook. So just to remind everyone, we have got a very good sustainability proposition at ZOTEFOAMS. We've got a nitrogen-based foaming process, which makes very good use of the polymers that we buy in. Our products are primarily used in avoiding emissions. We make foams which are lighter, and those foams are used for protection, insulation, those types of things. 85% of our revenues are from products considered green by the FTSE Russell definition. We build ESG and sustainability into all our decision making around the business. So that's evident in some of our ESG scoring recently. So we're coming out very high ratings across MSCI, the London Stock Exchange Green Economy Mark, etc., meaning that, you know, very much in the wheelhouse for investors with sustainability funds or benchmark criteria there. And in particular, if we think about the resource product, what I'll do, Paul, is if we can just switch the screen off for a sec. I have here an example. This is actually a resource carton, and it's made with our material. It looks and like you'd expect to see on the shelf. It's got the standard plastic top. This can be thrown in the recycling bin along with your high-density polyethylene milk carton. You put it in the recycling bin with the milk carton, it will be recycled in the HDPE polymer stream, and that's something that we've already validated. That carton was made with 30% recycled content, and the product, if it is recycled, we can use our recyclate to make that carton again. The product we've had validated by an external consultant, having about a 50% lower carbon footprint than competitive product out there. It complies with all, I say all legislation. That's a broad claim. I wouldn't say that, because legislation is different in every region, etc. But the way legislation is going, it's really trying to look at making materials recyclable in a circular way, so back into themselves, the same use, and we are certainly aligned with that. We have a pilot facility, as I mentioned, in Denmark. We have our technical team based out of North America and up in Massachusetts, and we are looking to see how we commercialize this. And that may involve a strategic partner, because this is something where the market is so big, and on a global basis, this is definitely an opportunity where, if we are successful, ZOTEFOAMS cannot and would not want to expect to do that alone. So that's the business as we see it. So key messages: very good revenue growth, strong PBT, up 30%. Our operating profit is up 49% of the underlying foam business. The 2 major things that we're working on, Nike footwear and the resource, we've signed milestone agreements there to support those. Good strong cash generation and dividend up. If we look at the full year, we are reaffirming that we remain confident that we can deliver a full year market expectations. We've had a good start to the year, it's nice to have money in the bank, if you like. The short-term outlook is tempered somewhat by the industrial outlook and markets. You won't be surprised to hear that, but that's okay, because in some of the other markets, like aviation, we are back-end loaded. So it feels like we're taking a cautious but responsible approach to the market today. And in those expectations, we do think we'll get a little bit of a headwind from the dollar, around 128 compared to the first half. And we expect to get some benefit from the lower polymer costs just for a short period, but through the end of this year before they return to a more normal level. So trading in line with market expectations, and lots to look forward to good progress within the business. So that's the end of my and Gary's presentation. We are happy to take questions. I'll turn over to Paul.
Fantastic. Gary, David, thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions just using that Q&A tab just situated on the right-hand corner of the screen. Just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. David, Gary did have several pre-submitted questions, so perhaps we can start off the Q&A session with those, if I may. The first one reads as follows: what rival foam supplier do Adidas use in their shoes?
So Adidas use something called Boost. It's a thermoplastic elastomer made by a polymer company called BASF, a German company, who developed some proprietary foaming technology for that. It basically turns it into little balls of foam, a bit like styrofoam, that they then heat and weld together. So it's a very different process, and it's the major polymer manufacturer, major chemical company actually, foaming their own polymer.
That's great, thank you. Next one we've got here is: what sort of margins do you hope to achieve with Resource? Obviously, appreciate it sort of early in that process.
It is. I think I would rather pass on that. I think it's a bit early to really say that. But what I will say is that there are a whole load of different drivers of this technology in different parts of the market globally. And so in some parts of the market, be much more accepting of our product and be a much higher value proposition than potentially others, depending on legislation, consumer preferences, etc., etc. So I think it's too early to give an answer to that. But what I would say is that typically as you are growing and scaling up a business, the money goes to invest and scale rather than bottom line profit. So we will see how that pans out. But we are looking very seriously for an industrial partner or partners to join us on this journey.
That's great, thank you. We've got on here about electric battery casings. Any developments with foam linings on that front?
I think I used this as an example in one of the other presentations, maybe a year ago or 6 months ago. There are a whole load of industrial markets that we're looking at. Electric vehicle batteries is one of them. We do have some business in Asia in relation to that. But it's not a major part of our business at the moment. So it's a thinking about it, developing into, but not a major contributor at the moment.
That's great. And the last one we've got here is: are you aiming for mainland China?
Personally, or I'm not.
I guess that's from your operational point of view, from setting up operations.
Well, in that context, no, we've not said that we are. I think we putting another foam plant somewhere is a very significant investment, and one of the things we consider is the ability to protect our intellectual property versus the market and the growth rates, etc. So not at the moment. We do have a facility in Kunshan, which is about an hour outside Shanghai, taking our foams and manufacturing insulation products for the local market, but no plans to go in there as a foamer of polymers at the moment.
That's great. That concludes those pre-submitted questions. As you can see, we've had several questions come through during the meeting itself. So
Yeah.
I should ask you just to click on that Q&A tab, perhaps start at the top and work your
Yeah.
way through and just read out those where appropriate to do so, and I'll pick up
All
from you
right.
at the end.
Paul. So the first question is from Andrew R. In fact, lots of questions from Andrew R. Does the joint development agreement that you recently announced contain exclusivity provisions, and does it solely relate to beverage cartons? So yes, it's solely related to beverage cartons, and we haven't disclosed any other details on that, but I wouldn't take that as a yes or a no, Andrew. So just I'm not at liberty to go through that. What is the JDA partner contributing to the resource project? Well, essentially, we are making a product that can go into a packaging machine and be turned into a carton filled with juice, for example. So all of that downstream technology is, today focused on a particular what we call liquid paperboard carton. And to prove that our technology can go down the filling line in a sterile environment, we can fold it, we can seal it, we can put the cap on, all under existing machine operating conditions. That's what the partner's looking at. So, and we're doing it in conjunction with them. Next question, is your energy cost hedged? Wholesale energy prices have reduced significantly since last year, so will your energy costs go down next year? Gary, do you want to?
Do you want to do Andrew's third one afterwards then?
Oh, yeah, just take them as they come. Go ahead. We'll jump around.
Yeah. It's before this one. This is SAT P, right?
Yeah.
So is your energy cost hedges? So we actually purchase forward, so they're not theoretically hedges. We are just buying ahead. We have a predetermined program with our energy supplier. That as we get closer, clearly we lift the level of purchasing subject to forward pricing mechanisms, which weren't favourable last year. So in effect, we're not hedged. We're just purchased, right? And we have then obviously we have to, there are certain limits within. We've got a commitment, so we need to manufacture and use and utilise that amount of energy. So. And also energy prices have reduced significantly. So will your energy costs go down next year? If they're coming down, yes, because we've got an X amount. We're almost 100% through this year. We've got 30, say, levels of percentage deteriorating through maybe the first half of next year, and then we're pretty exposed, i.e., or we have opportunity in the second half of next year. So we will capture the benefits of the movement down. We just soften the impacts of prices going up or down based on our forward purchasing strategy.
Okay, we really are taking these in order they come, so we're jumping about back to resource. What is the approximate planned scale of the in-market trials for the European retail partner? It's in the tens of thousands, and that's sufficient for them to judge that there've been no sterility problems, no leakage problems, consumer reaction, the normal things you would expect. So at that level, it's hours or days on a machine. For us, it's not much more than that. So we've got plenty of ability to scale beyond that. But it's a controlled size trial, which is perfect for us, I think. So next question, Harry. Do you want to read out that?
Yep. How much more would you pay in interest if you had to refinance all your debt tomorrow, ignoring the benefit of any fixed hedges held now? I don't know, because I haven't gone out to market to find out what the current offerings are. I would imagine they're way high. They're higher. I mean, our mechanisms are a ratcheted margin above base. So base is base, right? That would be the same. But I imagine that we probably, we refinanced in February last year. We have banks that are familiar with us. that I would hope therefore rate us lower risk. But obviously there will be some underlying factors that might drive their internal decision making and offers to put it up a bit. I can't predict that. Don't know. I'm not in that game, so it's hard to say. Certainly, as far as hedges, I'm not quite sure. That doesn't really make much of a difference. I mean, in the grand scheme of things, with 28 million of debt, we've got FX hedges in that might give us, might secure a couple of million one way or the other of revenue. Makes very little impact on the actual number. So not sure that's the answer, but not a lot is not a lot of impact from hedges, and I don't really know what the banks are offering at the moment in terms of rates, so it's hard to know. But it feels hard to believe we get a better deal. We've got a very good deal. We timed it really well. So I think we're good through 27. I'll worry about it a bit near the time.
All right. Next question from Nicholas C. Are you under price pressure from customers with falling costs, or can you hold on to selling price? So there are certain parts of the polyolefin market where customers are looking at, current polymer prices and saying, look, you guys' price aren't matched to that. The polymer prices come down. You haven't changed your prices. So we are under discussion about what the right price is. But the energy costs are higher, labor costs are higher, and other inflationary costs are in there. So it's not all about that one easy to get to polymer cost. So, but we have price discussions with customers, all the time, and so it's about getting that right. In some cases, I would expect that we would either switch to different products or right price, but these are it's against a backdrop of a polymer price which is currently low compared to the long run average. And as Gary said, the margin over ethylene is almost zero at the moment. So that's not sustainable for the polymer price producers. And therefore, we fully expect that polymer price to jump up again. If we go back sort of pre-COVID, polymer price for a long time moved in a range, plus or minus 100 euros a ton, and or 150 euros a ton, and Zotefoams just absorbed the swings and roundabouts of that, gave our customers stable pricing. So that's the intent. We would hope to get back to that, so that allows the customers to get on with developing their business with a kind of fixed price. It's very difficult for them to constantly reprice with their customers. There are a few exceptions to that, like the automotive industry, who are much more focused on, if it goes down, we want a cost reduction. If it goes up, don't come and ask for a price increase. So we manage that in a different way, but it is something which is a fairly active dialogue at the moment, but it has been for 2 years. Mike L, why is MuCell revenue reduced by 44% if it's due to already sold technology from the previous year? I think if you look at it as a percentage, Mike, you see quite a big number. If you look at it as an absolute, it's not that big a number. But the main movement in that is we had one customer of ours whose customer had an intent to switch to a product, and backtracked on that intent, and so our customer wasn't able to or wasn't willing to continue to pay the fees to maintain the exclusive license position for that. We've seen this before. I think it's my understanding of that is I can't really tell much about it because of confidentiality, but it was a major FMCG company who were offered a lower carbon footprint, recyclable product, and decided to go with a higher carbon footprint, non-recyclable product because it was a bit cheaper, despite espousing quite green credentials. So I've seen that before. I'm no doubt see it again, but it might be something that comes back in the future. We'll see. Question from Neil W. Of all the products described, you make no mention of Zotek N commercial development. How is that going? Well, actually, Neil, we're seeing right now quite a lot of interest in Zotek N again, particularly in body protection type applications and some other things. So it's pretty busy right now in development, but it's relatively, compared to the rest of the business, small in revenue at the moment. It's still an active range of products. I think we've done a good work to improve those products in terms of performance, and you know, we have been through, for example, testing for various applications, and it's failed in some areas. We've redeveloped it and passed. So it's a constantly moving, you know, forward towards the target, and it, you know, it's been it's of high interest to a lot of people. It's not quite found its niche yet, but I'm relatively a bit more hopeful about that than I was 6 months ago. Scott M, can you give some detail on wage inflation in each region and what you expect going forward? Well, I think, Scott, we have the main body of people at ZOTEFOAMS is employed in the UK, and you know, we don't give out specific numbers on pay inflation, but it's so between 5 and 10 that we've seen from April. In the US, in Poland, in China, you know, wage inflation is not significantly different than it is in the UK, maybe a little bit more in Poland, because of the economy is doing really well and workers in high demand. But the other areas, it's in that, you know, high single digits range. Paul C, what is the outlook for volumes in half two given the drop in half one? Well, as I said, we expect you know, a bit of weakness through Q3, particularly in continental Europe industrial markets within the Azote business. It is a seasonal business, Azote, anyway. Q3 is usually softer, mainly because of European holidays. I think it's a bit early to say about Q4, but you know, we are continuing to run quite hard and build some inventory because we actually believe Q4 might end up being quite busy. So we'll see about that, but Q3 certainly feels like the economies are a little bit softer and maybe a little bit inventory coming out of the system, which if it reverses can reverse quite quickly and you know, end up with demand coming through on us with short notice. So we'll see about that. Again, Paul C, is there still growth opportunities around non-running sports, e.g. golf shoes? Well, the golf shoes are never going to take a lot of foam, but the more general point is, are we going to non-running? Nike's next biggest category is basketball. We are being specified on basketball shoes, and those shoes, I believe, are scheduled to be launched next year. So yes, is the answer to that. Ed T, the company's ROCE is low single digit. What's the long-term aim on that, Gary?
Yeah, well, certainly it's low at single digit, not low single digit, just to be clear.
Oh yeah, bit difference.
You know, before our capital investment, it was around 14-15%. We put a lot of capacity in. That doesn't get filled straight away, and it had a purpose to accommodate our growth plans and our increasing shift to a strategic shift towards high performance products with higher margins. We're on our journey through that. You know, you don't put capacity in and then fill it straight away. So our expectations are through the coming years that we fill the plants with capacity. That gives us a couple of %. That we increasingly mix enrich either up through AZO or across from top AZO into specified AZO into HPP. That gives us another few %. MuCell will resolve itself and result MuCell with a 2 million half year. So if you look at last year's loss, that's a good 1.5 to 2% movement. And then other smaller elements within. So you take those, that's 6, 7, 8%, top it onto your 9 that we're at. That takes you to 16, 17. So we have a clear strategy to increase that. Obviously, something can come up with a growth company, an opportunity to come up that requires capital that might drop it back. But fundamentally, we see this business as being certainly above 15.
Okay, Scott M. Can you talk a little about how you picked the JDA partner, and did any partners approach you? Well, we were looking for a partner who had the right level of expertise, market presence, etc., in the packaging business, and specifically carton packaging to support our commercial trials. In the event, the partner we have has all of those, so we are very happy working with them, and they're extraordinarily committed at top level to doing this. I think in thinking about these things, you've always got to think about the benefits of really working closely with someone versus the benefits of trying to spread your resources and do different things with different people. And here I feel that we have a really good partner. We have been talking to, either we approached them or they approached us, talking to quite a number of people about the resource technology over the past 12 months. In a number of aspects, including as potential investors and our partners, and that goes on. So it's a continually changing landscape on that. But I think the team that we have put together, predominantly focused on getting the in-market validation. That's something which could really change the perception of how people think about this opportunity. Again, Neil W., what percentage of your current cross-linked foams are actually recycled globally? Not what could be, but what are in practice. The reason for cross-linking foams, Neil, is that it makes them more robust and stable and therefore long-lasting. And most of our applications are in things which are designed for long use. So if you think about a car, a wing mirror gasket in a car would last the life of a car, so 10 years. It's not designed to be thrown away. So in that manufacturing process, there is scrap, and at the moment, globally, a very high percentage, I would say not all, but almost all of that scrap is seen as a valuable resource. It's collected and in fact sold by us and by our customers to people doing other things with it. So end of life, I find it almost impossible to answer that question, because there are so many different applications using our foams that I couldn't begin to tell you how much is recycled. I know it's practically possible, and I know that our process and the cross-linking methods we use are make it easier and more beneficial to recycle than our competitors. So, Scott M., over the last 6 months, has Resource taken more or less management bandwidth And what about the next 6 months? Well, Scott, we have a dedicated team here. We have brought in people who are ex-Tetra Pak. We've brought in people who are machinery experts. We've got a leader who's got many years in the packaging industry, as well as quality expert who used to run like on site. He was the quality and sterility manager for Coca-Cola or PepsiCo, I think, sites, etc. So we've built a team that has the required expertise, who are 100% dedicated here, as well as our MuCell guys and the guys from Denmark that we brought into the business last year. In terms of my time, I'm pretty involved in this. It's a decent amount of my time, and certainly with Gary and with the board, it's a subject on every board meeting to a decent extent. So it's something we're taking very seriously, but I think we are properly resourced to deliver this at this stage. And along with our partners who are putting in their people and teams who are very keen. It's a decent amount of time and effort in here. Okay, I think this is the last question. Harry O. How long do you think a reasonable investor should wait before judging the carton investment to be successful? Okay. Well, I think with all developments, there are kind of critical milestones or value inflection points. So, when the patent is issued is one of them, when your first, pre-production trial comes, when your first market trial comes, when your first revenue comes. I think all of these are potentially value inflection points. I think the big one is in market validation. If we can get tens of thousands of cartons into the market with juice and they are sold through on a retailer, then I think that's a big plus. And I don't think the market in the bigger sense, the packaging market, is going to be silent about this, because there haven't really been any contenders to liquid paperboard for forever. The new technology hasn't really come out, and we know that they are struggling with some of the challenges on sustainability, recyclability, circularity. So lots of questions being asked. I'll probably have to do an interview or two with Packaging News or the Grocer or something along the way. So I don't know. Is it going to be successful? We certainly believe so. We hope so. We're working towards that. One of the big questions is, what segments of the market really value this, and where do we go next? And we are looking to perhaps outline a few options on that over the next 6 months. We're not going to do a market trial and then say what next. We'll have plans in place for that. And then final question, I think I may have missed this earlier. Are you progressing discussions with potential partners for other resource applications, i.e. pouches, cups, trays? Not at the moment. We are so busy with cartons that we've decided that even though potentially there are other applications, that we are going to focus on the carton applications at the moment.
That's fantastic. David, Gary, thank you as always for covering off every single question we've had through. And of course, any further questions that come along, the team will be able to review those and we'll publish responses where appropriate to do so on the Investor Meet Company platform. David, I don't know if there's anything further just to add just before we conclude today's session. And thank you just for running over slightly and before we redirect.
No, I'm good. I'm good, Gary. No, thank you very much.
Perfect. Well, look, David, Gary, thanks indeed for updating investors today. Can I please ask investors not to close the session and should be automatically redirected in order that you can provide your feedback for the team to understand your views and expectations. This will only take a few moments to complete. It's greatly valued by the company. On behalf of the management team of ZOTEFOAMS PLC, I'd like to thank you for attending today's presentation and good afternoon to you all.